People talk about achieving a 30% annual return as if it were a miracle. That's not the case. It's a calculation backed by patience and discipline, two elements many people lack. Everyone wants extraordinary returns, but no one wants to live an ordinary life. They become ordinary, spend recklessly, diversify haphazardly, and hope for great results. But it doesn't work that way. I've met many investors throughout my life. Perhaps a handful could achieve a 20% annual return, and only a few of them understood why they were successful. You can't achieve 30% by striving for a community. You succeed by avoiding wise decisions. That's the bottom line. A 30% annual return isn't achieved by pursuing innovation. It comes from avoiding the tide. With every new era, new ways to fail emerge. Conglomerates, dot-coms, subprime companies, cryptocurrencies, meme stocks. The names may change, but human nature never does. Survival is more important than intelligence. If you lose once, it's impossible to make 30%. So the basic rule to always remember is this: don't go bankrupt. Never. That's a way to lose excitement. It's a boring way to win. Bankruptcy should be avoided. Compound interest will do the rest. Time is on your side, just as long as you survive. You don't need to own hundreds of stocks. A few really good stocks, and the patience to hold them, is all it takes. Academics call this risky, but ignorance is more dangerous. If you know what you have, even 10 positions can be enough. If luck is on your side, capitalize on it. If luck isn't, limit yourself. Most people do the opposite. They pile big bets on hunches and small bets on faith. They care about actions, not results. They confuse actions with progress. The real formula is simpler. Avoid unnecessary boldness in most situations. Remain resolute when the odds arise. Here's the secret to winning 30%. Not every year, but throughout life. If you don't understand it, don't own it. Investing isn't about knowing everything. It's about knowing what you're ignorant about. It's not about the breadth of your network, but about the honesty of your boundaries. You can't claim to know everything forever. The market rewards humility more than intelligence. Humility keeps you alive long enough for your intelligence to shine through. Every major crash, LTCM, housing, crypto, begins with people becoming uninformed. They thought models could outsmart their judgment, but they didn't. That's why it's good to stay small. Develop clear vision. Keep your head. Depth always trumps breadth. Because common sense, compounded year after year, is akin to genius. Patience is a most underappreciated asset in the financial world. The market rewards those who do nothing for the longest time. Most investors devalue their portfolios because they interrupt compound interest in their haste. It's like planting a tree and trying to monitor its growth every week. Warren and I built a fortune through boredom. For most of our careers, we studied, thought, and said no. We only said yes when stupidity was affordable. You can't predict the timing of stupidity. You have to be prepared for it. When others panic, you have to remain rational and liquid. Its hidden advantage is the power of patience, freedom. The impatient call it boring. The patient call it freedom. And what compound interest offers is freedom, silent, constant, and inevitable. While everyone else aspires to be a genius, I pursue the absence of stupidity. In mathematics, if you can't solve a problem by going forward, we try to solve it by going backward. This is called reversal, and it applies to investing as well. Stop asking, how can I make 30%? Ask, what should I do to avoid losing 50%? Then you should avoid them. Debt, arrogance, greed, impatience. These have destroyed more wealth than your own misfortune, if not more. You don't need to try to predict the future. You just need to avoid the obvious pitfalls. You don't need to look for intelligence. You just need logic. You don't need complexity. You just need clarity. If you simply avoid the obvious pitfalls that everyone fears, you'll outperform 90% of investors. Because performance is the measure of long-term survival, and extraordinary patience is the most effective way to achieve extraordinary results. People spend their lives chasing the glitter. I spent my life trying not to be stupid. This path is simpler and infinitely more profitable. You don't need perfect intelligence to achieve superior returns. Just a strong character is enough. In bull markets, everyone appears smart. In bear markets, everyone must confront themselves. The key difference between these two situations is not intelligence, but personal attitude. Temperament isn't something you can fake in a moment of fear. If your portfolio loses 30% of its value, your real loss isn't money. You lose your ability to observe, and regaining that perspective can take years. That's why the greatest investors throughout history weren't usually mathematicians. In fact, they were philosophers. They understood that behavior affects their careers as much as capital. Benjamin Graham used to say, "The investor's greatest problem, perhaps their greatest enemy, is themselves." He expressed this not poetically, but with a diagnosis. The biggest threat to the markets isn't inflation, interest rates, or algorithms, but the people who react to them. You don't control the money. You manage yourself. Emotions, like stocks, are constantly traded. Fear grows, greed rises, and doubt deepens. Every decision you make in the market is a reflection of your inner uncertainty. That's why an investor who cultivates self-discipline eventually owns everything. You can outsource research. You can replicate your portfolios. But it's impossible to leave faith to someone else. Belief, like trust, is built over time. It's earned in bear markets. It's not earned in bull markets. The irony is this: markets reward boredom. But boredom puts pressure on people. That's why they seek excitement and call it strategy. If you want better results, learn to be bored aesthetically. This is where discipline lies, quietly, profitably. Compound interest is touted as a secret. But this isn't true. It's actually fragile. Compound interest is like a snowball rolling downhill. The real secret lies not in the snowball itself, but in the peak. The slope represents time. Profit represents discipline. When you lose these two elements, the process ends. That's why survival is devalued. It becomes boring until you understand that truly great wealth requires survival without giving up. Most people fail not because of their mistakes, but because they couldn't fight long enough to succeed. If you remain patient when others panic, if you remain sensible when others are angry, you not only preserve your capital, you also preserve your freedom to act when opportunities arise. These weren't just Benjamin Graham's students. They possessed consistency. They didn't predict recessions. They far outlasted recessions. They didn't follow trends. They waited for the world to rebalance. Resilience isn't in the newspapers, but it leaves a lasting legacy. The real advantage in investing isn't the ability to know, but the ability to demonstrate resilience. The world continues to reward those who are rational longer than the market can remain irrational. People think wealth is tangible: cars, houses, investments. True wealth, however, lies in tranquility. It's money not spent. It's risk not taken. It's temptation resisted. Every dollar not wasted translates into greater value: peace. The modern world sells noise. Real investors buy silence. When you stop trying to impress, you start making progress. And when you stop competing for attention, you start truly increasing attention over time. Markets don't care what you want. They reflect you. Every price movement is a Rorschach test of collective emotions, a mirror that reveals greed, panic, hope, and denial. That's why two investors can look at the same chart and develop opposing perceptions. The chart remains the same, but their psychological state changes. So, you should stop challenging the mirror. Try to outlast your reflection. Your portfolio is your diary. It relentlessly records your decisions. Make sure it tells a story worth reading. Benjamin Graham never sold excitement. He offered clarity. He taught generations how to think, not how to push their luck. He believed that investing wasn't about predicting the future, but about patiently, logically, perhaps for years, waiting for those opportunities. You don't have to be a genius to choose this path. You just need to be rational when others aren't. Because the market always rewards only one person, those who survive. If you can do this, protect your investment, stay rational, and put the hard work into practice, you won't just profit. You'll also find peace. That's what true compound interest is: money, mental balance, and meaning. I've encountered many people who chase numbers throughout their lives. They invest, monitor benchmarks, and add decimals. But there's one crucial question they never stop asking. Why all this? If your money doesn't bring peace, it's not truly wealth. If your earnings don't bring freedom, they're just another job. Benjamin Graham didn't intend to make you rich. He aimed to make you rational. Because rationality is the foundation of all wealth, financial, emotional, and even ethical. He understood a truth most people never grasp. You can't win market battles. Over time, you become part of the market. As you learn to control your reactions, you begin to think. You stop rushing and start making choices. And at some point along this journey, you realize that money isn't the real goal of the game. The important thing is to be cool, intelligent, and able to proceed with quiet determination. The loudest investors often start with losses. The quiet ones prefer to think before acting. Those who continue to rack up gains even after the noise has subsided. Noise attracts attention. It sells. But silence brings profit. A quiet investor doesn't constantly seek approval. They let the scoreboard speak for itself. They don't argue with nonsense. They know how to wait. They understand that money is like prestige, hard to earn, easy to lose, and impossible to recover in a moment of panic. Silence is the most powerful language, because when the crowd roars, you can finally be left alone. Every generation thinks it's smarter than the one before it. Every generation grows up understanding that this isn't true. We continue to develop new technologies, artificial intelligence, data analysis, algorithms, but we continue to repeat old mistakes: fear, greed, ego, and impatience. The market is a quantitative reflection of humanity, an analysis of our impulses, a chart of our emotions, and a reflection of our behavior. As long as humans exist, the rules will remain the same. Names change, products evolve, titles are updated. But psychology, it always remains constant. That's why Graham's ideas are relevant in every age. Because he didn't write for a specific era. He spoke to humanity. Financial complexity burdens the insecure. When you don't understand something, you pay the price: costs, stress, and lost sleep. The greatest investors simplify things until the truth becomes clear. They don't need complex formulas to prove patience. They don't need graphs to understand greed. Simplicity isn't ignorance. It comes across as competence. There's the inherent confidence of someone who knows that compound interest relies on time and limitations, not magic. If you can't explain your strategy to a 12-year-old, it means you don't understand it well enough. And if that makes you uneasy, it's not a strategy, it's a trap. As your life draws to a close, you won't be fixated on stock charts. Rather, you'll look back on moments of peace, mornings spent unhurried, choices you don't regret, and opportunities you seized without haste. Graham's greatest gift wasn't a formula. It was his perspective. He reminded us that finance, at its best, isn't about markets. Meaning is what matters. Money doesn't equip you with wisdom, But if wisdom is pursued correctly, it often brings wealth. So judge your success not by what you have, but by how peacefully you can stand. In the end, we'll always come back to the same conclusion. Stay alive, stay sane, and let time do its work. The crowd will mock your patience. They'll find it boring. They'll call it old-fashioned. And then, they'll quietly fade away. Your patience will become permanence. You'll see your wealth grow by waiting, not against the markets. And in that waiting, you'll discover what Benjamin Graham realized long ago. True intelligence isn't about being the brightest, but about maintaining balance. Because when things go right, everyone makes money. But when things go wrong, only a rational mind can protect it. This isn't just about investing. It's about living a conscious life, choosing clarity over chaos, patience over haste, and wisdom over wealth. This is Benjamin Graham's method, and it's the only permanent path. Success in investing isn't about constant effort, but about allowing opportunities to grow. Compound interest rewards patience, not action. The market rewards the calmest mind, not the most active. If you look at history's most successful investors, names like Graham, Buffett, Templeton, Klarman, not all of them acted rashly. They didn't hold back on brilliant ideas. They only acted when favorable conditions were favorable. I call this selective courage. They waited, and when opportunity finally presented itself, they acted with confidence, not with a loud voice. In contrast, today's average investor behaves like a bird caught in a casino. They flutter, panic, and perceive action as progress. They think investing equates to intelligence. But in reality, all they do is turn their efforts into noise. Remembering the 1974 bear market feels like yesterday. The air was filled with fear. Stocks were so worthless that you could find the value of major companies in office furniture. As the crowds filed out, we waited patiently, watched, and listened. When panic reached its peak, we quietly bought. We did this not because we were smart, but because we were patient. Years later, the same assets people sold out of fear became the foundation of enduring wealth. This is the hidden power of doing nothing smart. Waiting creates options. When you avoid the habit of constantly reacting, you can preserve two valuable resources: capital and composure. These are the real advantages in a world where speed is paramount. The market's cruel deception creates the belief that action always makes sense. It's the misconception that being active is the same as being wise. But in reality, every trade you make carefully is as valuable as every trade you make correctly. The older I get, the more I understand this. The calmer you remain, the more satisfying your results. True investing isn't about fun. It's about staying in the game long enough for the math of compound interest to work in your favor. Buffett once said, "The stock market is a tool for transferring money from the impatient to the patient." This isn't a joke. Impatient investors seek excitement, while patient investors gain freedom. Casinos never go bankrupt because people hate waiting. The market works similarly, only this time you can be the casino. You don't have to win every game, just win the important ones. Make only the right shots. That's how riches are built, not through activity, but through selective inactivity. Wait. Wait through boredom. Wait through doubt. Wait even when others mock you. Because when opportunity finally arrives, it will belong to the ready, not the restless. You don't need to be smarter than others. You just need to outlast them. And in the long run, patience grows much faster than intelligence. Most people chase intelligence. I've spent my life avoiding stupidity, and it's been more rewarding. You don't need to anticipate every move. Simply avoid moves that will bankrupt you. This idea originated not with Wall Street, but with mathematics. In mathematics, when you can't solve a problem effectively, you turn it upside down. When you turn it upside down, instead of asking, how can I win? You ask, how can I avoid losing? Then, you avoid doing things that lead to failure. Investing works this way too. Don't ask, how can I make 30% this year? Ask, what can I do to avoid losing 50%? The answers will be clearer, simpler, and more reliable, and they will likely save your financial life. The world glorifies complexity, but complexity is where good ideas often die. The smartest people weren't victims of the worst luck. They were influenced by overthinking. They developed strategies so complex they couldn't even explain them. They used money they didn't have, on systems they didn't understand. You can't capitalize on what you can't explain. That's why our rule has always been, rather than occasionally being clever, always try to avoid stupidity. This isn't humility, it's calculation. For every mistake avoided secretly accumulates and grows. Every crisis avoided becomes an unseen gain. Consider most investors. They make emotional decisions. They get swept away by trends. They listen to the advice of people who can't even manage their own lives. And when everything finally collapses, they blame the market and end up making the same mistakes again. You can't fix irrational thinking with more knowledge. You can fix it by making fewer mistakes. If your sole goal were to avoid arrogance, envy, leverage, and ignorance, you would have a chance of outperforming most investors worldwide, and you would have done it quietly. But the word avoid doesn't exactly convey the impression of heroism. Saying, I haven't had a financial loss this year, isn't something to brag about. People are thrill seekers. They want fireworks. But investing isn't about fireworks. It's about survival. Staying in the game requires humility, the courage to say, I might be wrong. This is at the heart of Graham's thinking, a margin of safety. Reversal encourages humility. Remember, the market benefits only from your discipline, not your ego. I once joked, all I want is to know where I'm going to die, so I never go there. That's an example of reversal in a sentence. You don't have to know the secrets to success. You just have to avoid the paths that lead to destruction. There aren't many secrets, but these are clear: debt, arrogance, greed, and haste. These 4 factors have destroyed far more fortunes than bad timing. If you want extraordinary returns, start by eliminating the behaviors that make them impossible. Stop investing in every rumor. Stop investing in things you don't understand. Stop borrowing to speculate. Stop conflating luck with skill. Avoid these 4 things and you'll outperform 90% of investors. Don't do it because you're smart, but because you're smart. Avoiding stupidity doesn't mean shying away from action, but it means taking action only when there are sensible options. Before every investment, ask yourself a simple question. If this turns out badly, can I survive financially? If the answer is no, walk away. If the answer is yes, and the potential reward seems worth the risk, proceed with caution. This is true rationality. Every mistake avoided creates an imperceptible advantage. Every disaster avoided increases your ability to act in the future. It's not glamorous, but it's uninterrupted. And it works. Those who pursue brilliance will continue to take bold steps and make excuses. You, on the other hand, will continue to profit quietly. And finally, when the noise subsides, the results will speak for themselves. Don't try to be brilliant. Just avoid being stupid. In a complex world, clarity becomes a superpower. In an environment dominated by ego, humility becomes armor. You can't always predict the future, but you can always avoid obvious pitfalls. And over time, that's the difference between the rich and the regretful. Because the truth is simple. You can't achieve 30% returns with a mind that's crashing at 5% volatility. The market tests your temperament, not your intelligence. And it's not intelligence, but character that determines the ability to survive long enough to experience the magic of compound interest. There comes a time in every investor's life when charts, numbers, and theories no longer matter, and only character remains. Your true advantage isn't your IQ, your software, or your latest strategy. It's your ability to maintain your composure while others panic in the crowd. You don't realize it at first. At first, you think success is about insight. If you find the right secret, you think you'll win. I used to think so too. I read everything, memorized the odds, and studied the financial statements like a priest. But markets are relentless in teaching humility. They expose your impatience. They punish your ego. And they frequently remind you that the game is an emotional struggle, not an intellectual one. I once saw a highly intelligent man lose everything in a year. He wasn't brave, not in the classical sense, but he couldn't bear to wait. He believed that action was a sign of control. The market disagreed. He mistook volatility for opportunity and optimism for talent. In reality, he couldn't wait long enough for compound interest to work its silent work. He took action. The best investors aren't the most talented, but the most emotionally disciplined. They understand that the real battle isn't external, not in the market, but internally. Against fear, against envy, resisting the desperate need to do something when doing nothing would be the right decision. This paradox of investing is that your intuition deceives you. Your emotions are programmed for survival, not wealth. In the jungle, action keeps you alive. But in the markets, patience protects you. I learned this lesson slowly, painfully, and at great cost. There were years when I thought the market was falling, but that wasn't the case. In fact, I had hit rock bottom. When you stop resisting it, when you learn to remain calm when the world is in panic, you begin to see real progress begin. Then you fully grasp the meaning of Graham's statement. The essence of investing is not managing returns, but managing risk. Returns come with discipline. Discipline is the result of character. And character begins with humility. You don't need to predict the future to win. You simply need to stay in the present, allowing time to work to your advantage. Compound returns are nothing short of remarkable. You just need to keep them. Every investor eventually faces a defining moment. Not a moment when everything rises, but a moment when everything collapses. The choice you make in that moment determines who you will become. Do you panic? Or do you choose to wait? The truth is, wealth is built during periods of stagnation, not at the height of upward mobility. While the crowds rush, patiently prepare. And when the chaos subsides, there are those left standing, not because they were lucky, but because they were still there. This is the simple beauty of Graham's philosophy. It's not about greed, but about resilience. He taught us to view the market as your servant, not your master. It appears before you daily, offering prices, voicing its opinions, and shouting with urgency. But it can't force you to act. You decide when to act and when to wait. This is true power, an exponential effect. I once told a student, if you want to get rich, aim not to beat others, but to outlast them. He laughed at first, but then, faced with his first bear market, he couldn't laugh anymore. Because what seems ordinary today will feel precious in 10 years. What moves slowly now will become inevitable in the future. And what brings peace like nothing, patience, balance, discipline, will eventually become everything. Here's the final rule, the rule that ties it all together. Endure. Endure the hardship. Endure the doubt. Endure the times when you feel like nothing is working, because that's when things will work out. From Graham to Buffett to Munger, great investors have had one thing in common. They never stopped learning and never delayed waiting. They waited long enough to see the tranquility of time rewarded. This is a truth no one tells you. You don't need to chase flashy successes. You don't need to anticipate the next big opportunity. Just stay rational. The irrational world will continue until its own destruction. And when that happens, when the noise subsides, when the markets crash, when everyone else is on the defensive, you'll stand there, quiet and ready. Because compound returns don't reward the noisy. They reward the persistent. And perhaps this is the greatest lesson Benjamin Graham left us. Ultimately, wealth is built not by those who move the fastest, but by those who wait the longest, and by those who think clearly while waiting. Most people fail the investment test long before they've even finished the test. The market is not a fair teacher, but a cruel psychologist. It knows exactly which buttons to push: fear, greed, envy, impatience. These four elements destroy more wealth than any recession or crash. If you can't control your own emotions, the market takes control for you and demands interest on top of that. When I talk about psychology, I'm not talking about the typical motivational posters that say believe in yourself. I'm about emotional control, the ability to remain calm in moments of world chaos. The discipline to remain rational when everyone around you is losing their minds. The patience to remain calm when others are selling their souls for a headline. If you can do that, if you can stay calm no matter how hard it is, congratulations. You've made it into the top 1% of investors. What do the rest do? They don't invest. They react. They replace their discipline with dopamine, their patience with panic, their clarity with noise. I remember the dot-com bubble vividly. It wasn't economics. It was pure madness. Smart individuals, those who should have known better, were completely lost. They acquired companies that had no profit, no existence, and no logic, just .com at the end of their names. They called it innovation. I called it a case of being a madman in a tie. When everything fell apart, they were stunned. It was as if gravity had been suspended for a few years and suddenly returned. That's how most investors react. They act emotionally, not rationally. But they don't have a strategy. They seem to have developed some kind of reaction. Your psychology affects your earnings far more than your IQ. The average investor with a calm demeanor can outperform a genius who panics every time the market moves. Because financial markets reward pressure, not reason. When everyone else is excited, I choose caution. When everyone else is fearful, I become interested. People call this alternative thinking, but it simply means emotional independence, the ability to think independently of the fear or greed of others. This independence stems from a single understanding. You don't have to participate in every market upset. Warren and I didn't spend our days fixated on stocks. We read, thought, and waited. Because noise breeds folly, and that creates opportunities only for those who can face it calmly. This is the rarest skill in investing, finding clarity amidst chaos. You can't buy it. You can develop it, slowly and painfully, by tolerating uncertainty and building confidence. A crucial point many people don't understand. The market doesn't need you to act. To act, you first need yourself. The market will remain unstable, as if on a constantly slippery slope. If you can't overcome this, it's not investment. You're chasing fun. People get anxious because they confuse volatility with danger. But volatility is the price to pay for high returns. If you can't tolerate it, you can't make a profit. It's like being a surfer complaining about the waves. You can't ride them and be afraid of them at the same time. The truth is, doing nothing can often be unbearable because it forces you to face uncertainty. People choose to do wrong rather than face uncertainty. They act, even foolishly, to escape the fear of inaction. They may crave the feeling of progress. But in investing, progress stems not from action, but from the income-generating components. And compound interest thrives on time, not activity. Look at the greatest investors in history: Graham, Buffett, Fisher. Their defining characteristic wasn't constant action. It was selective aggression. They waited a long time, and when the moment came, They intervened with sudden attacks. The amateurs, on the other hand, fluttered around like birds in a casino, noisy, agitated, and observant of every detail. They mistook the chaos for opportunity. I remember the 1974 bear market. Everyone thought the world was ending. Stocks were cheaper than wallpaper. There was a general sense of panic. We waited and watched. When fear peaked, we quietly bought companies for pennies on the dollar. There was no genius here, only patience and cash. We saw those who mocked us for being overly cautious in good times lose when the wind turned. We were ready. They weren't. The hidden advantage of waiting is that it creates options. By not wasting time on frivolous activities, you preserve both your capital and your common sense. When the real opportunity arises, you won't be exhausted. You'll be prepared. The biggest illusion of the market is making people believe that being efficient equals being smart. It rewards noise, not intelligence. It glorifies chaos over thought. But as I got older, this became more apparent. The quieter you are, the better your results. Real investing isn't about thrill-seeking. It's about endurance. You win not by being the smartest, but by sticking it out for long enough to let the mathematics of compound interest give you an edge. Buffett once said, "The stock market is a mechanism that transfers money from the impatient to the patient." He was right. The impatient find it boring. The patient find it a freedom. There's a reason casinos never go bankrupt. They benefit from people's ability to wait. The stock market works similarly, where you can act like a casino. You don't have to win every game. You just wait for the cards to fall in your favor and then place a big bet. That's how you get a 30% return, not on every roll, but only on the big ones. Wait. Wait even if you're bored. Wait even if there's doubt. Wait until you're ridiculed. Because opportunities always arise, and they're always for the prepared, not the anxious. There's no need to be smarter than others. You just have to be more patient. And patience develops faster over time than genius ever could. People spend their lives chasing genius, studying every new theory, implementing every new strategy, quoting every new leader. I spend my life avoiding stupidity. That's a much more attainable goal. It also yields more profit. Everyone's searching for the next mystery, the next breakthrough, or the magic formula. Here I ask a tedious question. What can go wrong? Because avoiding stupidity is the most effective way to ensure safe progress in investing. I learned this concept in mathematics, not finance. In mathematics, if you can't solve a problem directly, you go back and find a solution. You turn things upside down. Instead of asking, "How do I succeed?" you ask, "How do I fail?" Then you try to avoid making those mistakes. That's the effect of the reversal. Don't think, "How do I make 30% when investing?" Ask, "How do I avoid losing 50%? The answers are often simpler, safer, and more rewarding. The world loves complexity, but many disasters I've witnessed stem from brilliant individuals complicating things. They created structures they didn't understand. They used levers they couldn't manage. They pursued ideas they couldn't even explain to a simple child. You can't endure what you don't understand. You can't protect what you can't explain. That's why I always say, it's remarkable how much of an advantage you can gain by focusing solely on avoiding stupidity rather than trying to be incredibly clever. This isn't modesty, it's a strategy. Most investors often react emotionally. They trade out of greed. They sell out of fear. They imitate others because they lack confidence. They read the analyses of people who can't even predict their own marriages. As a result, they lose, they pile on the markets, and often end up relapsing into their bad habits. You can't fix stupidity with more knowledge. It can be fixed with fewer mistakes. If you simply avoid the obvious mistakes of overconfidence, jealousy, leverage, and ignorance, you'll outperform 90% of investors without breaking a sweat. But this is hard for people to accept. Avoiding doesn't seem brave. Saying, "I haven't lost any money this year," isn't exactly flattering. They're looking for excitement. They want to be in the headlines. They want to feel like they've accomplished something. But investing isn't about excitement. It's about staying in the game. And staying in the game requires humility, the willingness to say, "I might be wrong." This is where the reversal tactic challenges you. It forces you to confront the reality that markets don't care about your opinions. Reality doesn't reward ego. Indeed, discovery rewards. I once said, "All I want is to know where I'm going to die, so I'll never go there." This is an example of reversal in a single sentence. You can't know everything about success. You just have to avoid the paths that lead to destruction. These paths are fewer than you think, but if you look carefully, they're all clearly marked. Debt, arrogance, greed, and impatience. These four things destroy more wealth than bad luck does. And every generation continues to learn this lesson the hard way. If you aim to achieve a 30% return, you must start by eliminating behaviors that don't guarantee it. Stop believing every rumor. Stop investing in things you don't understand. Stop borrowing to speculate. Stop reasoning about bull markets. Pay attention to these 4 points, and you'll instantly outperform 90% of investors. Not by virtue of intelligence, but by virtue of logic. Avoiding foolishness doesn't mean abstaining from action. It means taking action only when the risks are reasonable. It means filtering every opportunity with a single, simple question. If this goes wrong, will I survive financially? If the answer is no, back off. If the answer is yes, and the risk is small compared to the rewards, then proceed with caution. This is the reversal technique applied in everyday life. The beauty of this approach is often invisible. Every mistake you avoid yields quiet gains. Every disaster you avoid increases your capacity to act in the future. It's not glamorous. It's not dramatic. It simply works effectively. Those who pursue brilliance will continue to take bold steps and make bold excuses. You, on the other hand, will continue to win quietly. Ultimately, remember that the situation reveals the truth. Stop trying to be brilliant. Avoid foolishness. In a complex world, clarity is an advantage. In an environment dominated by ego, humility becomes your protection. You can't always predict the future, but you can always avoid obvious pitfalls. This is the truth that separates the rich from the losers over time. You can't achieve a 30% gain with a mindset that fluctuates by 5%. This is a truth no one wants to face. Because the market tests your personality traits, not your intelligence. In my younger years, I associated success in investing with acquiring more knowledge. Now I know that needing less is the key. Less need for excitement. Less guesswork. Less noise. The fewer objects you need from the market, the more freedom you gain. Everyone is looking for profit, but I'm only looking for survival. Because staying alive, staying debt-free, logical, and rational activates the silent magic of compound interest. You don't need to act drastically to achieve your goals. You simply need to let time take its natural course. That's how wealth is created, not by intelligence, but by endurance. So, my final advice to anyone 60 and over, or anyone smart enough to think like this, is this. Protect your capital, protect your mind, and protect your time. Because these 3 things are the only assets that, when lost, will never come back. The market will test your patience, your ego, and your convictions. But if you can remain calm when everyone else is losing their minds, if you can keep your head down when the noise gets louder, if you can remember that time, not time itself, builds wealth, then you have acquired a skill that even the greatest investors envy. Rational patience. This is Benjamin Graham's philosophy. It always has been, and it always will be. Many people fail in investing without understanding the questions. The market tests not only intelligence, but also human frailties. Fear, greed, envy, and impatience. These four emotions have ruined more portfolios throughout history than any single business recession. If you can't control yourself, the market will take care of you and pay you for it. When I talk about psychology, I'm not talking about motivational posters or the optimism that fades after a bad day. I'm talking about emotional discipline, the ability to remain calm even when your environment becomes chaotic. If you can do this, congratulations, you've already made it into the wealthiest 1% of investors. Because most people don't act rationally. They're swept away by hormones and headlines. During the dot-com frenzy, I witnessed some people who thought they were smart go crazy. They were buying companies with no revenue or customers. They simply added .com to their names. They called it innovation. I called it madness in a jacket. When everything collapsed, they were stunned, as if gravity had been forgotten for a while and suddenly returned. That's how most investors live, rationally, not emotionally. They have no strategies. They only have emotional reactions masquerading as strategies. It influences your psychology more than your IQ in determining your returns. A smart but impatient investor will always lose to a calm fool, because markets reward stability under stress more than they reward intelligence. When everyone else is enthusiastic, be skeptical. When everyone else is fearful, be curious. This isn't contrarianism, it's emotional independence. And this independence is built by realizing one truth. You don't need to participate in every drama the market has to offer. Warren and I never spent our days fixated on price charts. We read, we thought, we waited. Because noise fuels stupidity, and opportunities arise only for those who can see it. That's the real skill, providing clarity in times of chaos. You can't buy it with money. You develop it gradually, by learning to be comfortable with uncertainty and your own company. Many people never grasp this. The market doesn't need to move. You need to move. The market will fluctuate for the rest of your life. If you can't tolerate it, you might be in the wrong place. People panic because they perceive fluctuations as a threat. But that's not the case. Volatility is the price of achieving high returns. If you can't handle it, you won't enjoy the reward. It's like complaining about a roller coaster at a park. You either scream your way past or judge those riding, lagging behind. And then there's envy. It's the most harmful and destructive emotion in investing. There will always be people who are wealthier, younger, and luckier. What's the point? Envy doesn't make you smarter. It just makes you reckless. When people try to compare themselves to someone they shouldn't be competing with in the first place, they jeopardize their own wealth. When you eliminate envy, you eliminate half the mistakes in your financial situation. Then greed kicks in, constantly whispering to you, one more deal, one more trade, one more risk. But when things go wrong, greed takes back more than it gives. That's why rational thinking is more important than optimism. Optimism builds wealth. Rationality is responsible for protecting it. And of course, there's fear, the oldest and most valuable of emotions. Fear causes people to sell valuable businesses at exorbitant prices. When opportunities are screaming, they prefer to hold them in cash. It turns long-term thinkers into short-term thinkers who experience sudden panic attacks and ultimately into long-term losers. You can't fake courage to overcome fear. You overcome fear by grasping the possibilities, by remembering that volatility is not the same as loss. Panic alone is the element that transforms volatility into loss. I've always believed that keeping your emotions in check is like creating a safe haven within your mind. When your ego and fear are in control, you think clearly, and clear thinking is integrated. You don't make big profits by being the smartest person in the room. You make big profits by being the calmest person. If you can't sleep, even if your portfolio loses 50% of its value, you deserve the lower returns you'll get from emotional reactions. Because the real risk lies not in the market, but in your own reactions to it. Test yourself before trying to succeed in the market. The real competition isn't with other investors, but with your own psychology. And in the long run, the market rewards those with common sense when everyone else is losing their minds. Compound interest, when judged by compound interest, is a lot like genius. Everyone talks about compound interest. Most people struggle to grasp it. Almost no one has the character to allow interest to truly function. Compound interest is simple in theory but brutal in practice, because the math will only work if it's not obstructed by your own mistakes. Intelligence isn't required for big profits. You just need to do what intelligence doesn't do. Let it grow quietly. Compound interest isn't magic. It's a mathematical phenomenon. But many people see it as a miracle that can be accelerated, and in doing so, they lose their impact. Einstein called compound interest the eighth wonder of the world. He was right about this, because it stems from the fact that many people are emotionally unable to handle how slowly they see results. The first 10 years are like watching paint dry. The next 20 years are like seeing money grow on trees, but only if you haven't cut down the tree too early. The truth is, compound interest rewards not only intelligence, but also perseverance. The longer your capital lasts, the greater your advantage. There's no need to rush. All you can do is ruin everything with impatience. That's why so many investors never get rich. Not because they can't make a profit, but because they don't let the profits they do make compound long enough. They sell too soon. They panic too quickly. They chase the next great idea. By doing this, they disrupt the one force in the financial world that requires only time, not human ingenuity. Buffett and I say that our greatest successes weren't stock selection, but surviving long enough for compound interest to take effect. And that's a valid observation. A large portion of Berkshire Hathaway's value accrued after Warren turned 60. 60 years of discipline. And finally, the snowball reached critical mass. That's how wealth builds, slowly at first, then suddenly. Like glaciers melting silently, like a valley flooding. But most people sabotage themselves just before this flood. They can't resist the temptation to take profits. They compare investing to farming, harvesting too early, and then wondering why your field is empty. Compound interest rewards thinking over a decade, not quarterly. If you're looking for fun, go to Las Vegas. If you're looking for wealth, stay calm and let time work for you. When I was younger, I think I didn't pay enough attention to the psychological aspect of compound interest. This isn't just about math, it's also about identity. You have to be someone who can wait 20 to 30 years without losing faith. That's quite rare. But that's where the 30% gain lies, a patience no one can endure. Because compound interest isn't about rapid growth, it's about long-term boredom. And many people can't stand that boredom. They choose to break the formula rather than tolerate the silence. The greatest advantage of compound interest isn't the interest itself, but the habits required to make it happen. Saving, consistency, rationality, and patience. These habits are boring. That's why they're rare. But the market transfers wealth from the quietly patient to the restless every day. If you want to understand compound interest, don't look at charts. Focus on your own character. Because a character decides who can stay put while the world tells you to act. And every unnecessary action costs you years of development. A fool measures success in weeks. A wise person measures success in decades. A fool measures success in weeks. But a wise investor measures it in decades, in habits, and in quiet mornings that no one else notices. True wealth isn't the number on the screen, but inner peace. It's the peace that comes from your values remaining constant even as the market fluctuates. Look, the most challenging part of investing isn't finding the next opportunity. The real challenge is being able to endure your own inner impulses long enough to achieve positive results. The market fosters patience. And because patience often looks like doing nothing, you're forced to wait while everyone else is doing something. Therein lies the paradox. The more you chase high returns, the further they elude you. The more opportunities you allow for returns to come to you, the faster they grow. That's why discipline is the source of true compounding power. It's not interest, it's not timing, it's not even knowledge. People love to talk about how Warren and I generated specific returns or found undervalued stocks. But that's never the point. The real point is that we never gave up. Even when prices plummeted or headlines were doom and gloom, we didn't back down. We continued to unravel year after year, decade after decade, just as the numbers seemed to be incapable of any other solution than compound interest. Because ultimately, investing isn't about outperforming others. It's about being able to withstand your own worst choices. And once you understand this, a shift begins within you. You lose your concern about being right. You start to worry about being consistent. You stop constantly checking prices. You start to pay attention to your mood every day. Then you become a character investor. Markets constantly test you. They surround you with promises during bull runs, and they pester you with warnings during crashes. But if you've patiently built your castle, neither whispering nor shouting matters. I hope the younger generation grasps this. The secret formula isn't about predicting the next step. It's about preparing your mind so that no step can topple you. Because the market doesn't destroy wealth. It simply transfers it, from the impatient to the patient, from the emotional to the rational, from the short term to the long term. Looking back now, I realize this isn't just about finance. It's the essence of life. Every principle that protects your money also secures your peace of mind. Security, discipline, and reason. These points apply to relationships, careers, and happiness as well. The mathematics of compound interest is the mathematics of how you exist. Every decision you make, every limitation you impose, quietly multiplies behind the scenes. You may not see the results immediately, but one day, you'll realize that time has transformed your efforts into something extraordinary. So, if there's one rule I'd like to leave behind, it can be summarized as follows. Don't rush those who deserve patience. The market, like life, rewards the few who can wait without losing faith. Pauses thoughtfully. As you can see, most people think it's the secret of wisdom. But really, the real secret is temperament. A calm heart ultimately wins. And perhaps that's the only lesson the story is trying to convey before it ends. A wise man measures success not in weeks, but in decades, sometimes even a lifetime. That's why we never sold C's toffees. That's why we held on to Coca-Cola long after everyone else had grown bored. That's why we let Apple buy back its shares instead of letting it act like a market toy. We weren't looking for thrills. We were looking for inevitability. The interesting thing about compound interest is that it becomes more effective as we get older, when fewer people have the patience or the health to do it. That's why I emphasize that the most valuable partners in finance are longevity and sanity. Live long enough, think rationally enough, and compound interest will take care of the rest. Most individuals tend to underestimate the impact a consistent 20% return can have over a lifetime. Few fully understand this. Furthermore, few take advantage of it. And almost no one manages to wait long enough to realize its true potential. Therefore, rule number 7. Let time race against you. Don't interrupt compound interest. Don't interfere. Don't overthink it. Because in the end, wealth is not a result of how fast you move. It is a product of how long you can sustain it. When acknowledged and valued, Time is the ultimate investor. On the contrary, ego is the priciest possession you will ever have. It takes away your chances, connections, and returns, often all at once. Many people believe that being smart makes them wealthy. It doesn't. If that were the case, every professor would be a millionaire. What genuinely creates wealth is humility, the capacity to admit, I don't know, and act based on that acknowledgement. Ego pushes you to forecast outcomes. Humility encourages you to be prepared. In this field, the one who is ready outperforms the one who tries to predict. You won't achieve 30% returns if you're preoccupied with proving your intelligence is superior to the market's. The market has no interest in your IQ. It only values your discipline. Ego seeks dominance, whereas the market thrives on unpredictability. The harder you strive to control it, the more it undermines you. That's why the world of finance is littered with bright minds who believe they could outsmart randomness. I have witnessed over my lifetime exceptionally intelligent individuals making foolish decisions simply because they couldn't bear to blend in. They'd rather suffer significant financial losses than achieve modest gains quietly. They desired to be correct, not wealthy. Those objectives seldom align. Warren and I never aimed to appear brilliant. Our focus was simply on maintaining our composure. That ambition is far more rewarding. Staying sane leads to growth. Ego leads to an explosion. If you can't bear to be wrong from time to time, you won't endure as an investor. Every successful investor has experienced wrong turns, occasionally in a major way. The secret is not in avoiding errors. It lies in preventing disaster. Ego magnifies minor errors into major catastrophes. Humility transforms them into opportunities for learning. This is why humility acts as a form of risk management. It safeguards your potential losses by fostering a healthy skepticism about your own intelligence. The instant you think you're infallible, you have already made a mistake. I have always found a straightforward question more valuable than an intricate theory. Could I be mistaken about this? That single question has preserved millions for me. On the other hand, individuals with advanced degrees and complicated models have gone bankrupt while assuming the world is predictable. They misinterpret precision for comprehension. They create formulas with multiple variables and overlook that one unpredictable human can dismantle it all in a single day. You don't require complexity to earn money. Clarity is what you need. Clarity starts with humility, recognizing what you do know, understanding what you don't, and operating within those limitations. Ego is fond of leverage. It seeks attention and validation. However, wealth isn't about gaining recognition. It's about lasting power. When you dismiss others' opinions, your compounding accelerates. Your choices become based on rational thought instead of societal expectations. This is why Warren and I never worried about quarterly results or magazine features. Our concern was about avoiding financial ruin. And that subtle humility, a readiness to appear unexciting over many years, led to our wealth. Additionally, ego obstructs your view of new opportunities. When you're overly self-involved, there's little space for fresh ideas. You cease to learn. You stop paying attention. In a rapidly changing world, being arrogant can lead to financial disaster. I've mentioned this before. Life, and consequently investing, involves ongoing education. Those who continuously seek knowledge tend to succeed. Those who believe they already have all the answers often decline. The finest investors I've encountered remained learners throughout their journey, inquisitive, modest, and willing to accept their mistakes. The least successful were those who felt entitled to success from the market. Ego drives you to follow trends that you don't fully grasp just to show you're participating. It leads you to trade excessively when patience would have yielded better outcomes. It suggests that taking action, any action, is superior to being patient. However, every move comes with a price. In investing, that price accumulates negatively. The market doesn't reward mere activity. It favors clarity. It appreciates the capacity to remain calm, quietly, while others are either panicking or celebrating. This is why very few individuals achieve outstanding results. They're too caught up in responding to distractions to recognize the actual signals. Ego proclaims, "I can predict the timing." Humility states, "I can endure it." And enduring, rather than making predictions, is what wealth is built upon. You might pass up a multitude of chances and still achieve great success if you simply evade collapse. But you can't bounce back from devastation. The numbers won't allow it. If you lose 50%, you must gain 100% just to break even. Lose your self-control once, and you may spend 10 years recovering what took you years to build. Thus, the true skill is not brilliance, it's resilience. The ability to remain solvent, logical, and humble long enough for compounding to work its wonders. Therefore, rule number 7. Because when everything settles, the patient investor will own the assets that the emotional investor sold in a hasty manner. And that, subtly and silently, is how wealth changes hands. From the hasty to the disciplined, from the arrogant to the modest, from the short-term thinkers to the long-term planners. Ego will insist that endurance is tedious, but the reality is, endurance is the closest thing to genius that you will ever require in the market. It doesn't necessitate forecasting the future, merely surviving it. It doesn't need perfect timing, just consistent soundness. The world remembers those who endured the longest, not those who traded the most. That's the irony of wealth. You don't succeed by outsmarting others. You succeed by outlasting them. It's not brilliance that preserves your wealth. It's steering clear of collapse. Ego can turn minor errors into catastrophic failures that end careers. Humility makes those same mistakes manageable. This is why humility isn't just a virtue. It's a means of managing risk. It constrains your potential losses because it compels you to self-reflect. Once you start believing you can't be mistaken, you've already set the stage for your own downfall. For many years, I have followed a straightforward question. Am I possibly making a mistake here? This inquiry, rather than any specific method, has saved me vast sums of money. At the same time, I have observed individuals with advanced degrees, powerful computers, and flawless models go bankrupt while mistakenly believing that the world is predictable. They mistake accuracy for true comprehension. They create formulas with numerous variables and overlook the fact that a single unpredictable person can disrupt the entire system in just one afternoon. You don't need intricate strategies to earn money. What you truly need is clarity. Clarity arises from humility, recognizing what you know, what you don't know, and operating within that reality. Ego craves leverage. It seeks recognition. It thrives on the false sense of control. However, true wealth is not about recognition. It's about resilience. When you stop worrying about others' opinions, you begin to grow faster because your choices are guided by rationality, not by pride. That's the reason Warren and I never focused on quarterly performances or magazine features. Our priority was to avoid financial ruin. And this humility, the willingness to appear unexciting for many years, quietly made us incredibly wealthy. Ego can cloud your perception of opportunities. When you are overly self-absorbed, there is no space for new insights. You cease to listen. You cease to learn. In a world that shifts daily, arrogance can lead to failure. I've emphasized before, both life and investing are continuous learning experiences. Those who continue to learn keep advancing. Those who believe they already know it all continue to decline. The most successful investors I've encountered were always students. They were curious, humble, and ready to be challenged. The least successful assume that the market was obliged to reward them. Ego compels you to pursue trends you don't truly grasp, merely to show you're involved. It leads you to act excessively when patience would yield greater rewards. It encourages bragging when you should be studying. And worst of all, it drives you to persist stubbornly when you should acknowledge failure. I have never encountered a humble individual who went bankrupt due to being cautious. But I've seen numerous arrogant individuals lose everything because they couldn't utter four simple words. I was wrong. This is the concealed price of ego. It robs you of your ability to learn. And without the capacity for learning, you're done for. Humility is not a sign of weakness. It is strength manifested as self-control. It is the capacity to confront uncertainty without collapsing. It keeps you flexible when others become overwhelmed by their confidence. If you observe closely, you will find a pattern. The investors who thrive over decades are not the most vocal. They are the ones who remain reserved. They adapt instead of predicting. They endure instead of boasting. Ultimately, in the long term, results matter more than personality. So, the eighth rule, and potentially the hardest of all, is this. Eliminate your ego before it destroys your investments. You don't need to be exceptional. You just have to be open to learning. You don't have to be the loudest. You simply need to be correct eventually. Humility ensures your financial stability. And that stability, when accumulated over many years, outperforms fleeting genius that bursts onto the scene every few years. The globe is populated with intelligent individuals who fail to maintain wealth, and modest individuals who manage to succeed quietly. After almost 90 years of observing markets, I can reveal the key. It's not about being exceptionally bright. It's about persistence. People dedicate their lives to finding quick fixes, consuming the latest books, pursuing trendy ideas, following new mentors, all in an effort to outweed a system that has remained constant since the very first transaction occurred. The market rewards a handful of straightforward actions that are repeatedly applied over time. Everything else is just background noise. Do you desire a 30% return? That's fine. Achieve it the difficult way, the only true way, by remaining calm when others panic, by staying put while others pursue excitement, by purchasing quality investments when they seem uninteresting and holding on to them when they feel tedious. There's no secret recipe, just commitment, patience, and the capability to disregard 99% of what is termed advice. Let's summarize. Rule 1. Never go bankrupt, under any circumstances. Rule 2. Make large bets only when the odds are heavily in your favor. Rule 3. Operate within your area of expertise. Rule 4. Learn to appreciate monotony. Rule 5. Reverse the logic. Steer clear of foolishness before seeking brilliance. Rule 6. Get control of your own mindset before trying to conquer the market. Rule 7. Allow time and compounding to do the heavy lifting for you. Rule 8. Keep your pride in check. Follow these guidelines, and achieving a 30% return becomes a reality instead of a mere dream. Many individuals struggle to adhere to these principles. They seem overly straightforward to prove sophistication, yet are challenging to implement. However, this is precisely what makes them effective. Complicated solutions may provide a sense of comfort to the uninformed. Simplicity, on the other hand, can intimidate them as it requires self-control. Self-control is the most valuable asset in finance. Everyone is eager to act. Very few are willing to exercise patience. This is why we consistently see average investors and wealthy brokers. In all my experiences, I have never witnessed anyone lose everything by staying logical. Yet, I have seen countless individuals fail due to their emotions. The distinction does not lie in smarts. It has to do with one's disposition. A composed mind prevails over a clever one. Interestingly, the more logical you become, the less thrilling your life may appear to outsiders. No drama or chaos, only a gradual and steady ascent. But that is the essence of genuine wealth, subtle rather than flashy, assured instead of exhilarating, patient rather than arrogant. In my youth, I believed success stemmed from brilliance. Now I recognize it's more about survival. If you can maintain your solvency, sanity, and patience over 50 years, the mathematics will manage itself. Simply being around to see opportunities is a reward in itself. Sustained presence and logic triumph over temporary flashes of brilliance time and again. Most people will fail to grasp this. They will continue to gamble, envy, and speculate. They'll confuse noise for wisdom and luck for expertise. They will repeatedly ask, "What's the next big opportunity?" instead of pondering, "What mistakes can I avoid today?" And when they run into trouble, they'll blame the market, not themselves. I'm not more intelligent than the masses. I have merely made fewer foolish choices. That's everything. I didn't pursue thrills. I sought logical thinking. I didn't crave applause. I aimed for inner peace. Eventually, those small rational decisions led to wealth, not just monetary, but also intellectual. Money represents one form of wealth. Knowledge represents another. And here's the ultimate insight. Knowledge grows exponentially as well. By continually learning, questioning, and reevaluating, the benefits permeate all aspects of your life. This is what I mean when I say, utilize all the intelligence and energy you possess to enhance your wisdom slightly each day. If you do this, money will naturally follow, quietly, consistently, and inevitably. So when someone approaches me and asks, "Ben, how can I achieve a 30% return annually?" I respond, shift your focus from returns to behavior. Because behavior accumulates more quickly than capital, and rational actions, maintained over a lifetime, transform average investors into legends. The mathematics of compounding is straightforward. The psychology behind it is not. Conquer both, and you'll understand why patience, not brilliance, governs the world. And if you remember nothing else from what I've shared, keep this in mind. You don't need to be exceptional to achieve remarkable results. You simply have to sidestep foolishness long enough for the remarkable to unfold naturally.